Hello and welcome to our next edition of the Power of Passive Investing. We have an amazing guest today, Jesse Khera. Jesse and I have known each other for a few years. I think we met during the pandemic, right? Jesse, just
Correct.
about when it
Yeah.
started, and we kind of hit it off. We're more or less local. Jesse is in the city and I'm in New Jersey, and we had a few conversations about the market and kind of stayed in touch. Jesse has been doing some really fun things, which he will share with us in a few minutes. So, without further ado, Jesse, I'd like to give you a floor, and I would love to hear from you what you have been up to and share with our audience a little bit about yourself and what you're doing, please.
Yeah, awesome. I'll keep it brief on my background. In short, I'm a student of economics, student of finance. Graduated back in it's been a few years now. Where I graduated university, majored in economics. Upon graduating, I moved down, worked with a financial services firm down in Atlanta. Did about 2 years. From there, I was recruited by more of a mutual fund, one of the largest privately held mutual fund firms out of Jersey City, New Jersey. Worked with them for about a year and a half, really in the capacity of an advisor consultant. So my job is to go out, meet, connect with financial advisors, the wirehouse, independent financial advisors, Morgan Stanley, UBS, you name it, I probably cover them. And my sole purpose in that role was to, one, share some of the strategies that we had, whether it be fixed income, whether it be equities, and two, learn a lot more about what they're currently working on. And really with the purpose of kind of shedding some light on what we offer in the hopes that maybe they offer our offerings to their investors. So with that firm, it was primarily liquid investments, fixed income equities. I did about a year and a half there, and then I was recruited by a larger private credit. So here we're talking more alternatives, anything outside of stocks, bonds, or cash. Worked with a private credit alternative shop based out of Midtown Manhattan. Started off as an internal wholesaler, which essentially means it was my job to set up meetings for the external, have him meet with financial advisors, consult on the alternative offerings. And then it was within the first year that I kind of graduated to covering the Midwest territory. So I was really circling, Minnesota, Dakotas, Iowa, Nebraska, more of a starter territory at the time. And
Mm-hmm.
within the first year, fortunately, my internal partner and I, we did really well, and we graduated to cover really the premier New York City territory. So it was really then where, I envisioned, I've always had that entrepreneurial spirit. It was really for me about building my own mountain. And then really during COVID, I decided, hey, now maybe is the perfect time. I had already made some alternative investments in real estate. I house hacked my first fourplex out in Minneapolis. That kind of got me addicted to real estate, ended up buying a few more condos, a few more multifamilies. And when I moved back to New York, it was kind of a now or never situation. So I tried to identify what are two pain points in the market? And I think the first one was transparency into what alternatives are. I think, many people look at the stock market as kind of the premier, but when you think about it, I mean, alternatives were around, you know, centuries before the stock market was, right? When
Yep.
we think about buying businesses, we think about buying real estate, alternatives are really the core. So one, I think I wanted to help spread awareness of what alternatives are. And two, another thing I noticed, especially kind of working in the market, reading a lot of PPMs, a lot of prospectuses, is I wanted to give more transparency into fees. So when I noticed some of the competitor funds that we had, and fortunately, because of that role that I had, I was able to read a lot of PPMs. I don't think, there's a lot of transparency of fees in when we're discussing ETFs and the stock market, but not so much in alternatives. So I wanted to kind of mitigate the fees on fee structure for investors. And all that I mean by that is when there's a private equity fund, they charge their own kind of baked in fund asset management fees. And typically when you go to your advisor, the financial advisor typically adds on an additional, anywhere from 1 to 3% placement fee on top of that. And even though investors are required to sign off on it, I'm not really sure they understand how much they're giving away by doing that.
Yeah.
So I launched yieldwink.com. In short, all that we do, we're an online platform. We connect investors to private investment opportunities. And here there is no fees on fee structure. There's no, commissions charged to be a part of the platform. It's a simple, typically a 2 and 20 fee, 2% asset management. And then, of course, after a hurdle, there's a waterfall structure. So we like to keep it simple. And fortunately, I've had the opportunity to work really not just one niche silo. We've worked, real estate, multifamily projects. We've done hotel developments. My partner, he's done a lot of hotel developments here in New York City. We recently just raised for one on Times Square, which I'm really thrilled about. We just closed it about 2 or 3 weeks ago now. And we've done a lot in private equity as well. We have a joint venture partnership with Gregory's Coffee. We're now looking to take down more nationally recognized franchisees or franchisors, I should say, and develop a fund around that. So a lot of exciting things. Excited to be here. As Alina alluded to, I've known Alina for quite a while now. I think it might have even been before the pandemic. It was another real estate offering I think we were looking at upstate
Yep.
together. So
Yes.
yeah, no, I'm very excited to be here.
Thank you, Jesse. Thank you. And thanks for sharing about your career progress. Very impressive how you excelled in your career in such a short period of time, started your own company and kind of diving into multiple sectors. And it's really great to hear that you're trying to bring more transparency into the alternative space and share more with investors, clients. I'm sure your clients and our audience definitely appreciates that. So we'll dive into that and we'll talk about some of the areas you cover as your potential target investment. So let's start with the first one. You said the first and foremost, and that's the asset class that we have a lot in common on share is commercial real estate. Let's kind of start with that. How did you decide that for yield doing commercial real estate would be the first commercial asset to dive into? Kind of walk us through
Yeah.
the strategy.
Yeah, great question. I think, for our first fund, I knew that, hey, if we can deliver strong results here, um, it'll encourage the snowball effect where if we do right by our investors, we get them strong, good returns, um, they'll come back for the second offering. So I wanted to stick with what I knew. At the time, it was I was more of a solopreneur. I didn't have, a co-partner at the time. So I wanted to stick with something that I knew. I got into real estate really around the age of 21 where I started reading books. I'm not sure I was listening to podcasts as much back then, but that's kind of where I got into learning YouTube, etc.
Mm-hmm.
I signed on my first property down in Atlanta, Georgia when I was 23 years old. And I'm not sure
Incredible.
if you read that book, Rich Dad, Poor Dad, but my dad has more of that poor dad mentality where it's, keep your money safe, keep it under your bed. I'm a bit of the opposite. When I purchased or when I signed the contract, I shouldn't say purchase because I didn't. I signed the contract on that property. It was actually my father who spoke me out of it. He's like, "Hey, what will you do when you come back to New York? Are you crazy, etc." Long story short, we ended up canceling the contract. That same property today, I had it under contract around 189,000. Today's probably worth a little north of 500,000. So I kind of made that promise to myself that, I'll never make the same mistake twice. When I lived in Minneapolis, that's really when I started listening to more podcasts. I think it was because of my larger territory. I had a lot of drives between Minneapolis and Des Moines, Iowa, even out to Omaha, Nebraska. So all you could really do on those long drives is educate yourself. I started listening to the Bigger Pocket podcast. I think that was a big one for me.
Yep.
Learning the different, types of resources, the types of tools other syndicators use, other real estate investors use. Learned a lot, and I decided to kind of pull the trigger back in, I want to say I was around the age of 27 or 28 at the time. This might have been maybe now it's 7 years ago where I
Mhm.
purchased my first fourplex. So similar situation. I call my dad. I let him know. He calls me crazy again. And this time I tell him, "Hey, Dad, don't call me. Once I close on the property, I'll give you a call." And fortunately, that's what I did. And now you should see my text messages. I mean, I have Zillow listings that my father sends me 24/7. So
That's
I'm glad that one went well, and it gave us kind of the encouragement to continue going.
amazing, amazing. And is your father part of your venture? Is he working
No,
with?
he is not. He has. I've encouraged him to make his own personal investments on the side of all the properties that I've really found for him. So when I first started, it was mostly single family homes. I would even go out myself and do the fix and flips. So that's how I ended up getting him involved. I wanted him to have a nice, kind of like a golden goose egg for his retirement, and slowly but surely he's formed it.
Amazing, amazing. It's incredible. I mean, we're all used to having elderly influence the young ones, and of course that happened in your case, just like for most of us, including myself.
Yeah,
But in your case, you were also able to influence your father when he saw the positive progress that you were making in your real estate investing journey. He decided to dive into that, and he believed in you. And I think that's the
yeah,
most critical component here. Because your father believed in you and saw what you were doing, he agreed and took a dive himself, which is absolutely amazing.
absolutely. Yeah.
Excellent. So, Jesse, that's how you started with commercial real estate. And for our audience, share, were you buying all the properties yourself, or were you creating fund of funds where you were partnering with other operators?
Yeah, initially before I formed YieldWink, it was all my own properties. I did do a partnership on one specifically with my uncle and my father, and this was a fixer-upper down in Columbia, South Carolina. That's a big market where I participate. But when it came to YieldWink, one of the things that I noticed that I'm sure you did too is you can focus a lot of time on single family, but the risk and the reward factor, if we're talking finance, call it a Sharpe ratio, it's much higher when we think about larger multifamily, right? I mean, in single family, if you have that one single family that's vacant, you're at 0% occupancy, 100% vacancy. But in multifamily, you have 10 units, you could still afford to have three, maybe four vacant units before you start really losing a dollar. So I think I looked at it as, what can the power of people coming together do? And that's when we decided, hey, maybe syndication is the right way to do it. Fortunately, I've made my mistakes on my own dime to the point where I've been doing it for multiple years that I felt safe saying, hey, dad, hey, uncle, hey, you know, friends of family, this is a good investment. Here's my underwriting. Would you guys like to participate? And that's
Mm-hmm.
where it initially started. And, fortunately, I kind of come from that finance background of raising capital. And now we're actually getting some of my previous relationships with financial advisors, with the independent RIAs involved as well.
Awesome, awesome. And just this is a perfect segue to our next question, where I wanted to ask you, how did you go about raising capital for your project?
Yeah, what's funny is I would say even today, about north of 80% of our new investors are referrals.
Amazing.
We've just grown a fantastic referral network. I mean, there have been, I want to say it was even this last deal that we did with Times Square, um, it was it was a big raise. We had to raise a little north of 3.3 million, and we only
Wow.
had a week to do it. That was the issue. So we had the signed operating agreement signed the last week of September, and the funds were due, September 31st.
Oh my God.
Yeah, yeah.
Hey.
It was just a lot of attorney language back and forth that really stalled it. And that's when I approached the attorneys again and said, "Hey, listen, 3.3 million in 7 days. I mean, I could raise money. I don't know if I could raise 3.3 million in 7 days." So that's when they noted back and said, "Hey, see how much you can raise. If you can raise anywhere close to that number, we'll give you an extension for 30 days." So fortunately, we were able to raise that 1.8 million. We got a 30-day extension and we fulfilled it. But even at that time, I was pretty nervous of, where are these funds going to come from? I mean, institutional investors, they need ample time to do their diligence, to do their underwriting. So we really did rely on retail investors, and quite frankly, it was literally just word of mouth. Investors that saw their returns on our first three, four offerings. They shared it with their family members. They liked the yield that we were sharing. So as of today, I would say the majority of the capital we raise is still from retail clients. So we have a good network base of doctors, a good network base of attorneys, a lot of accredited investors.
Mhm.
But now that we're moving, I shouldn't say moving into, I would say adding on fund structures, that's where we're trying to get more of the institutional capital involved.
Sure, sure.
From there, I think a lot of it initially will just be relationship based. Advisors I've worked with in the past who enjoyed working with me and vice versa, that I think may be ready to pull the trigger here.
Absolutely. How did you find doctors and attorneys? Is someone in the family, does someone in the family have that background?
Someone in the, we have one doctor in the family. We're not a big family of doctors. I'll say that. I think the majority are more so blue collar than white collar in my family.
Sure.
Um, we have one doctor, but I think a lot of it has just been through networking. Quite frankly, I've been to a few networking events now, even meeting with other multifamily syndicators who some of them just happen to be doctors. And syndicators, I mean, we understand deals, right? So if another GP has a great deal and I like his underwriting, yeah, I'm happy to invest with him as well.
Of course.
So, I mean, we've had investors that I met. Literally, there's one investor who's a doctor I met on a Delta flight 10 years ago who just decided to keep in touch and told me, hey, if you ever see a good investment, let me know. And today he's one of our largest investors. And it was just the 1 2.5 hour flight where he just remembered me. And I think he lost some money in Bitcoin a few years back. And that's when he tapped me and said, hey, do you know of any good investments? And that's when I shared, I just embarked on my own journey. Would you be interested? So a lot of it has been referrals. Get one doctor, his cousin ends up being in the pharmaceutical space. He's an investor, so it's kind of just spread from there.
That's really incredible. It speaks volume about your offerings and your track record, Jesse. So kudos to you for doing that. Let's switch over to your second channel of projects, hotel development. How did you get into that? How did you decide to work on hotel development, and how do you
Yeah.
envision expanding that?
Sure. Yeah. Quite frankly, hotel development is not my forte at all. I've never done a hotel development myself. It's actually my partner, who's much more senior than I am. I think he just celebrated his 55th birthday, but I'm sure he would prefer I say maybe 40th birthday.
Okay.
But no, he's been doing hotel developments for quite a while. He has three hotels in New York City, now two in Midtown, and the most recent one is on 48th Street and 7th Avenue. So
Mhm.
on that hotel, I was helping him underwrite the deal. So about 2 years ago, I was pouring through the loan documents. I was pouring through the model that was given to us by the contractor, who's also now a 50% partner in the deal. And that's kind of where I realized, in the loan agreement that if they were to pay down their loan size by 4 million, the lender would decrease the multiple that they're charging on the loan. So I just decided to take it upon myself and, run our own model and do the math. And we figure that if we were to raise that 4 million as preferred equity, I mean, the project would have an abundance of 3 million plus in net profits on the back end. So the question was, why would you not do it? And that's
Sure.
really where I started getting involved in hotels. So while I've been underwriting hotels for a bit, I haven't actually embarked on one. We do have one in the pipeline now where we have a signed LOI right on the beach in Myrtle Beach, North Carolina. So we plan to start our due diligence here, likely within the next 2 to 3 weeks on that deal.
Good luck, and that's really amazing. In our casual conversation, you mentioned a hotel in New York City. Is that a hotel development or is that a value add type of project?
I'm sorry, which is this the Times Square Hotel or?
Yeah, the Times Square Hotel.
Oh yeah, that's a ground up development. So my partner, he's a 25% owner of that project. So it's a 100-year ground lease. We shared it with a few developers, and one of the developers that came forward was Flintlock Construction. I mean, developed 47 plus hotels in New York City. We just thought they'd make great partners, and they loved the deal so much they wanted to come in as 50% partners.
Amazing.
So now they're actually 50% equity partners on the deal. My partner is a 25% partner, and a good friend of mine who's also, we call him my partner's partner, owns the other 25%. So
Got it.
that Yield Wink ended up getting involved with that deal. So the superstructure is already built. I mean, thank God for the kind of prolonged attorney discussions. By the time the discussions ended and we got the contract signed, the superstructure, the top floor was already finished. So now they're just working on the interior. They expect to complete it by August of next year.
Really? That fast?
That fast. Yeah. Yeah.
Incredible. How many stories is that?
It's 32 stories. It's 420 rooms.
Wow,
Yeah.
that's amazing. I thought you were gonna say 2, 3 years, not next year.
Oh
That's
no, yeah. By next year, they expect to have it up and running. So by May of next year, signage to go up. So just because it's Times Square, we'll have digital billboards. Those are expected to generate anywhere from 1.5 to 2 million in revenue.
and you will have your own billboards as well?
Correct. Well, the billboards will be leased out. Correct.
I see. And so it's additional stream of
Yeah.
income. Perfect. Excellent. Very nice. Jesse, so we talked about the first two channels of your operations. Let's kind of switch to the third channel that you recently added, the various stores. I'm sorry, that name just slipped my mind. The um,
Franchises.
franchises. Thank you. I'm sorry.
Absolutely. No, absolutely.
So yeah, share with us how did you get into franchises and why did you decide to kind of start investing in franchises?
Absolutely. Yeah, I think one of our, our thesis on investing is we kind of go where the puck is going, not currently where it's at. So we're always looking for value, right? Whether it's creating value or discovering value. And we just felt with the advent of food tech, with the advent of new technology, that we wanted to be either in the fast casual or the quick service kind of food space.
Okay.
So, as I'm sure you know, we have currently a joint venture partnership with Gregory's Coffee, right? Where
Yep.
we split the build out 50/50, we collect the cash flows 50/50, and that's done extremely well for us. So that was actually our first fund, which we launched a little over a year ago. I mean, year one cash net yield back to investors was around 29%. So needless to say, it's been doing fantastic. That's when we kind of started exploring what other types of businesses, whether it be nationally recognized franchises or whether it be your local kind of boring shops, where can we squeeze the most juice, and how can we utilize the new technology that's coming out today to help improve our margins. So
Hmm.
we started taking a deeper dive into quick service restaurants. Admittedly, I don't have much of a background in quick service, but we found multiple consultants, and within our network, I found a fantastic operating partner who I've known for 7+ years now. This is a gentleman who currently operates, 12 pizza stores out in Richmond, Virginia. He's done Singus Pizza out in here, New York. He's done Church's Chicken. He's done a multitude of different franchises. So I approached him a little over a year ago with a similar concept of, hey, can we create a cash flowing fund for investors that focuses on food, that focuses on either quick service or more fast casual type of restaurants or full service, and really just spitballing different ideas. We kind of wanted to think about how can technology, the technology that's coming out today, help us improve margins within the space, right? Because we all know technology is coming. Why not get into the space before it hits? And I think that's when you get a better multiple for it. If you go in once the technology is already there and your margins have improved, you're not really getting in at the best multiple. So we always like to add value into a business that we buy, which is why we started kind of considering QSR, quick service restaurants.
Yep.
I've been following specifically Burger King for quite a while now. I know, many franchisees may not be hot on Burger King for a number of reasons, but we kind of looked at, okay, what are their core competencies and who are the new entrants into the business and why do we think it could be a good kind of turnaround value add for us? So the first thing that we noticed is RBI, who's the parent company of Burger King, and they own Popeyes and Tim Hortons as well, and Firehouse Subs. They recruited Pat Doyle and Tom Curtis, and these two gentlemen, I believe, are, if not solely, are definitely one of the top two or two out of the top five responsible for the
Hmm.
turnaround at Domino's, right? If we look at Pizza Hut compared to Domino's today, I mean, Pizza Hut's probably closing one shop a day, while Domino's is doing absolutely fantastic.
Sure.
After their recruitment, I started watching Burger King a little closer. And then I noticed two things. One, I found out that Pat Doyle actually invested 30 million of his own money into the business.
Oh, wow.
Yeah, and second, I noticed that they purchased their largest franchisor group, which was the Carroll's Group, and they have a little over 1,000 Burger Kings within their network. So at that point, I realized, okay, they're really putting their money where their mouth is. They're looking to invest back into the business, and right now we have 12 Burger Kings under contract at a little over 3 times multiple on the business, which
Impressive.
really, even in today's market, is extremely low. It's a
Absolutely.
fantastic deal, right? So if you think about 3 to 4 years ago, they used to trade maybe 5 to 6 times multiple. Today we're getting them a little above three.
Well, Jesse, I must stop you at this point, and I apologize for that. But I'm sure if you were to buy one or two stores, it would probably still be 5 or 6x. I think because of the volume, because you're buying so many, you're able to get them at such a great price. Is that correct?
You know, it can go both ways because typically when you're purchasing businesses, the more revenue the business has, typically the higher the multiple it sells for. I
Mm-hmm.
think this is more of a unique position where one, the current franchisees are looking to retire. They're both 65 plus. After visiting the stores, it's really clear they don't really have a good grasp on their business. I mean, their sales have been going down anywhere from 2 to 7% year over year, right? So,
Oh, okay.
and, and it's you walk into one of those stores, you can visibly tell why. I mean, it's very obvious why their store sales are going down. So we actually compare them to the corporate owned stores within the areas. We looked at, what are their average unit volumes, AUVs on a per year basis versus what these stores are doing, and these stores are doing substantially worse. So
Mm-hmm.
one, we already know there's a value add play there. We go into it, we put in good operators, and we have a few operators we're already in conversation with that we plan to include into the business. We absolutely feel that we can turn sales around, but we're not really buying the business today based on future value. We're buying it based on today's value. So buying it
Sure.
at today's value at a low three multiple, the way we look at it is, I mean, hopefully, fingers crossed, we only see upside from here. But
Of
it's
course.
not just that, right? It's also what competitive advantages could we bring to the business? It's a lot easier to incorporate new technologies into a business when you're already at scale, because when you're at scale, you have more net cash flow that you can play with. So, for
Mm-hmm.
example, one of the things that we realized is, they have two people working the drive-throughs at all times. One person to take the orders, the second person to deliver the food and take the cash.
Mm-hmm.
These are things that, as long as your platform, your point of sale, your POS system is on the cloud, I mean, you could have somebody virtually take orders, right?
Yeah.
There's no need to actually have somebody there that you're paying $15 an hour when, quite frankly, you can find someone internationally at a fraction of the cost. So that was the first thing that we noticed. And how we noticed this, maybe I should have prefaced this, is we actually spent about 2 weeks down in one of the corporate stores with Burger King getting approved to become a franchise. And we are franchisees as of today. So we
Great.
kind of went in there to learn what are the efficiencies of the business and what are some of the inefficiencies. And some of the things that we noticed, I mean, right away off the bat, we can say, hey, technology can replace this, right? Like, for example, we followed the manager for about 2 hours counting the inventory in one of the locations. That can easily be done by a camera system that has the ability to track. They call it OCR, which is like optical recognition. As long as the camera knows what the box looks like, you can create a model on Python to determine what the inventory count is. That can then, via webhook, automatically go into your software system to tell you how much you need to order for the following week. So small efficiencies we feel that we could create can add more to labor hours that are needed on the floor of the business. So just small kind of efficiencies that we could create, I think could create tremendous value for the business. And those are the types of business that we're after, where we see poor management, poor use of tech, ability to add value.
It's interesting that you mentioned that you follow the store manager at owned by the corporate versus mom and pop.
Right.
Uh, is that because you expected that store to be more efficient than other stores?
Yeah, so for one, Burger King is headquartered in Miami, right? That's primarily why they send us out there. So the way we look at it is if the surrounding stores in Miami are not strong performers, you're not going to have strong performers anywhere else because that's kind of your hub. And wherever your hub is, you're always going to implement some of the strongest managers that you can find. So
Hmm.
the person that we were shadowing, they've been with Burger King for 20 plus years. I mean, if they're not efficient at the company, who is at that point, right? So I think we had a great mentor to learn from for those 2 weeks, and we were able to take a lot of notes. Typically, I would say it's always a mixed bag. Do franchisees run the business better or do corporate run the business better? I would probably lean towards franchisees just because they have more skin in the game.
Of
I
course.
would say they typically operate a little better than maybe corporate does. but it allowed us to really determine, what are the efficiencies, what are the inefficiencies, what's some of the tech tools that we can utilize in our stores from here.
I see. And Jesse, knowing that it's not real estate, it's franchises, and they have their own set of fees and so forth.
Yep.
Do you still believe there is enough on that bond that will be to cover, the investors, knowing it's a syndication and you have the
Oh,
expense?
more so than real estate. I
I
mean,
see.
when we buy real estate, today's market, I mean, you're really buying at the top, right? So in real estate today, I think there's a lot of what's known as vintage risk, where you're buying at the top with that in mind that in the future, hopefully, cap rates come down. Hopefully,
Yep.
they compress over time.
Mhm.
Seeing where rent rolls are today, seeing where the average between, what somebody's paying in rent versus their income is today, it's some of the highest we've seen. On average, you should spend no more than 30% of your income on rent. I mean, you look at New York City here, it's probably 45%, right? And that's not just solely to New York City. That's pretty much larger city average today. It's higher than 30%. So do
Mhm.
we really think there's a lot of opportunity for rental growth? Um, if there's wage growth, maybe, but if there's not wage growth and we're seeing inflation the way it's running today, I just don't see it, especially for those operators who are thinking, we'll exit in 3 to 5 years. I'm not sure it's there, but in these types of businesses where we're seeing a misalignment of supply and demand, we're seeing a lot of baby boomers that are hoping to retire, and quite frankly, it is the baby boomers who are the owners of these franchisees. There's
Yep.
not enough young blood in the business that has the capital to go out and buy, 12 Burger Kings, right? So as a franchisor, Burger King, Taco Bell, Wendy's, McDonald's, you name it, they're getting a lot more stringent on who they allow in because they've made their own mistakes and they've seen the mistakes of other franchisees. If you just let anybody in, most of these franchisees, they just try to cash out, refinance every opportunity they get. They don't really like to put back into the business. And personally, I think that's a mistake that a lot of these franchisors made is just allowing anyone in. So it's
Mhm.
created kind of like a disparity between supply and demand, which is what's allowing us to buy at such lower multiples in today's market. So I'm actually looking at it as, hey, now's the time to buy. It's a buyer's market.
Excellent, love it. And knowing that first and foremost, you're a real estate investor, are you buying the businesses only or real estate with it as well?
Great question. Out of the package, we try to buy as much real estate as we can, and two reasons for that. The first is one, in many fashions, you kind of control your own destiny, right? If you could structure it as, okay, for my operations, my rent will be a percentage of sales, if that's what's beneficial, or you can do annual increases on the rent. So
Mm.
you're still propping up your real estate at the same time. The second reason is there's also, in many cases, an arbitrage situation when you buy the real estate. And this is how the real estate's going to be valued based on the net operating income, right?
Mhm.
So based on today's sales that the store's making, if the rent to sales ratio is 9%, let's just use simple figures. Let's just say the business is bringing in $1 million. They could afford to pay 90,000 in rent.
Sure.
If we're the operator, now sales are $2 million, we could we could afford to pay maybe 180,000. And if we're paying that in rent, the valuation of the real estate is increasing dramatically because the next buyer is going to look at, okay, what type of income is this asset getting? And they're going to be buying based off the cap rate for the most part, right? I'm sure they'll do their dollar per square foot comps as well, but that's going to boost the value of the real estate. So if we can buy the real estate, increase the rent on ourselves, as long as it's still in line with, a 8 to 9% rent to sales ratio, we can really boost the value of our real estate, and we could just sell it off, lease it back to ourselves, and give our investors some capital back a lot faster.
Yeah, and really have a separate fund for real estate if you want to as well.
Exactly right. Exactly right. Yeah,
Do the depreciation and the cost segregation study and all of that and give
absolutely.
tax write-offs, which is
Yeah.
amazing.
Yeah.
Incredible. I love this model. And just say I like the fact that you're not just sticking to real estate, but you're diversifying into these other channels and really helping your clients to have a well balanced, well diversified portfolio. And that's actually what I write about in my book, Your Legacy on Main Street,
Yeah,
encouraging investors not to concentrate on Wall Street investments only, which is the stock market, but also dive in beyond Wall Street into Main Street, which is all of the alternatives, not just real estate, but buying the businesses as well. And it's amazing to see that you're doing that.
absolutely. And
Great.
I owe it a lot to my team. It's, my forte really is the real estate portion. I've learned a lot along the way. I've learned what kind of margins to expect in quick service, but really I prefer to kind of pivot to the masters, right? So if I know someone who's been doing QSR operations for 20 plus years, that's the partner I want to be running kind of that silo. So it's not like one man trying to operate a little bit of everything. It's you need to find the right mentors, you need to find the right consultants, and you need to find the right operating partners for whatever silo you're looking to get into.
100%. It's who, not how, essentially. You
Yeah.
find the who can implement, who can help you implement your vision. Amazing. Love it. Jesse, as we're wrapping up the interview, we always like to ask our audience, our interviewees two more of a personal questions. First one is, how can our audience find you? How can they reach out to you?
Yeah, you can reach me at J Khera. That's K, H as in hotel, E as in echo, R-A at yieldwink.com. So that's W-I-N-K. Feel free to check out our website. It's YieldWink, yield, Y-I-E-L-D, W-I-N-K.com. Sign up for our newsletter. So we do send a marketing newsletter every single month. A variety of topics. We talk about businesses. We talk about real estate. Sometimes I throw in some history in there as well. So that's the best way to keep in touch with us. And when you go on our website, you can click on the offerings tab. You can pour through what we've done in the past. And if I remember correctly, there's going to be a little pop-up. That's how you can join our newsletter.
Perfect, perfect. Thank you. And the last question is, how do you like to give back to your community?
Yeah, so great question because we're actually doing it now. I like to be a part of as many type of networking groups as I can. I'm a chairman with the Punjabi Chamber of Commerce here in New York. I'm looking to join more groups. We recently just started another business networking community where we can find a way to give back to other younger entrepreneurs, right? If someone has uh, a child in college looking for an internship, perhaps we can be of help in connecting you with a Fortune 500 or any company that's looking for interns. So that's kind of what we've been embarking on lately is forming our own kind of business mastermind group.
Amazing. I love it. I actually did something similar for the chamber in my town, where I'm also on the board of the local chamber. I created a virtual job board for exactly that reason to help like high schoolers or kids that are in college find either part-time jobs or internships because they need that experience. And that's the best place for them to find the experience through the local community. So I think it's
Absolutely.
great idea, Jesse, and good to hear that you guys are doing it. Jesse, thank you for this amazing interview. You're obviously doing some incredible things, and I hope our audience reaches out to you. Again, Jesse can be reached at jkara@yieldwing.com. Definitely reach out to Jesse, sign up for his newsletter, and take advantage of the value that he creates and adds through his newsletter. So thank you very much, Jesse, and
Thank you, Alina. Thank you so much. It was a pleasure.
thank you.
Talk soon.